Good morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I'm delighted today to be joined by Tom Hibbert from our Chief Investment Office.
Good morning, Jane.
Morning. As you know, Tom is our Chief Investment Strategist and here to help me cut through all the noise about what's going on in the markets, and hopefully then you can feel more informed, more confident and more in control of your financial future. So this week, Tom, I see that markets are hitting fresh new highs again.
Absolutely, yeah.
And apparently this is all about earnings, not just about hype. And it's the earnings that are driving the rally. AI is still the headline story, but there is a slightly uncomfortable question building in the markets right now. And that is AI actually starting to create inflation rather than to suppress it?
Yes.
So I want to get into that.
Absolutely.
So grab your coffee. Let's get into it. So as I say, if you just glance at the headlines, you might think this is a familiar story, with US equities up again 1.6% last week, reaching new highs, and tech leading from the front. But there are two layers to what's happening right now that I want you to talk to me about in a bit more detail, because they shape everything from investment returns to where interest rates might go next. So the obvious one is all around AI enthusiasm, investments flowing into technology, markets continuing to climb, which we've touched on before. I think the more interesting one is that the rally is being earned, not just imagined or hype. So can you just talk to us a little bit more about that so we can understand it?
Yeah, of course. And, the sun is definitely shining on equity markets at the moment in the US.
Unlike the rain out the window
it's raining
as we sit
in London,
here in London today with a tube
bit of a
strike.
damp day. Yeah, but,
Give us some positivity then.
Yeah, there's a lot of excitement and enthusiasm.
Good.
We've got the SpaceX IPO coming. We've got Anthropic's IPO coming.
Oh, yeah, I just saw that on Bloomberg.
There's a ton of excitement and hype out there. But what's interesting and what I think makes this rally quite durable is the fact that it's really justified by the strength of earnings that are coming through, not just in the tech sector. I mean, tech steals all the headlines, and that's where you're seeing the growth. But we've now had, in the US, 6 consecutive quarters of really solid double-digit earnings growth. Yeah. The most recent quarter, we had 20%, over 20% earnings growth. So this rally is not being driven by a fear of missing out. FOMO, but it's an earnings-driven story.
Good.
And, forward earnings last week, that's basically what analysts see over the next year. It hit a record high last week for the US.
Right.
The whole market. Technology, as I've said, and it's led for a long time, but still leading. Analysts see earnings growth of 47% for
in the next year.
In the next year.
Wow, that's huge, isn't it?
And next year, in 2027, 32% growth again. In 2025, we had 25% earnings growth. So we're already seeing numbers come through, and there's a huge amount of excitement around the earnings powered climb for the US equity market at the moment.
So and why is that so important compared to previous rallies or hype or fluff?
Yeah, and I think it's very cautious when you see very strong performance in a very momentum-driven market. There's a lot of excitement. There is a lot of hype.
Yeah.
It's important to look at the valuations.
Yes, because are they getting stretched then?
Yeah, and the markets are expensive, but you can have a period of strong performance where you see multiples, price to earnings multiples, really increase. So it's the amount you pay per unit of a company's earnings, price to earnings multiple.
Okay.
So at the moment, the whole US market is trading on 21 times price to earnings.
Okay.
That is quite expensive. It's above the long run average, but you're paying up for this earnings growth. And, in the late 90s, during the tech bubble, that same multiple hit 40 times.
Okay.
If you isolate the tech and tech-related companies, they're trading on 23 times earnings.
Okay.
So that's not massively expensive.
Versus
and when you
the
have
broader
earnings
market,
growth,
you said it 21 times.
21 times, yes. Yeah. And when you see the earnings growth that we are seeing, it can justify those high valuations as long as that earnings momentum is maintained and so strong earnings and strong earnings growth can justify high valuations. And that is what we've seen consistently for a while now. And, you look at the corporate landscape, the earnings landscape, it really still looks very positive. The outlook there is still very positive. So that makes this rally, this market, much more durable than something that is purely driven by hype or an irrational exuberance. There's there's not a huge amount of irrationality here.
Okay, got it. So investors are paying a premium, but it's a reasonable premium relative to growth that's forecast.
Exactly.
Or growth that's coming through and forecast.
Exactly.
Okay. So another healthier signal is that this rally seems to be broadening out a little bit. So it's not just about the mega cap stocks anymore, with earnings growth seen across other sectors. Should we just have a little dive into that and what's going on there?
Sure. So if you look at the broader market, we saw expected earnings for the large caps hit a record high last week, but actually the same for the mid and small caps as well.
Okay.
So this is the earnings momentum is positive for the entire market.
Okay.
But it is still, the epicenter of that strength is still a tech story. But you look at the amount of investment, the amount of spend, the insatiable demand for energy, you're seeing the beneficiaries across the market.
So it's dripping down all the way through the market.
Yeah. So, you look at now you're seeing a huge investment in clean energy, for example. And the clean energy index is up 43% year
Why
to
is that
date.
then?
Well, it's driven by insatiable demand for energy, particularly of things like data centers.
Because so AI drives the energy demand, drives
exactly, and the quickest way, and also on the back of this geopolitical risk and the energy shock that we're seeing, there's more of a drive to be energy independent, for countries to be energy independent. The quickest way, though, fundamentally, to get new electricity into the grid is through renewable sources. So solar is doing really, really well at the moment. And
that's not just the puff about clean energy, is it? That's a genuine need for it.
It's driven by economic utility rather than this idea of carbon neutrality.
Economic utility.
Exactly.
Okay,
exactly. So there's that, and then you've got there's a huge amount of demand for all of the commodities, the real world assets that are going into this infrastructure spend. So copper hit an all-time high in May, and we're seeing the materials sector performing very well. So data centers, energy demand, the physical build-out behind AI, we're seeing a broad impact across the market. And, generally the US economy has been very robust.
Yeah.
So the corporate landscape across America is pretty strong at the moment.
Yeah. So AI isn't just code, it's steel, power, and infrastructure.
Yeah, absolutely.
So we've been told that AI is all about productivity and that productivity should lead to lower inflation over time.
Yes.
So this is kind of what the nub of what I want to understand this week, and I think is quite interesting, is that we've gone from asking, will AI reduce inflation, to is it actually adding to it in the short term? And this sort of tension that's now emerging between AI and inflation.
Yeah, so which is coinciding with, already we've had 60 months now of inflation in the US being above the Fed's target. It's coincided with this higher oil price on the back of the Iran conflict. So the main argument that the chair of the Federal Reserve had for cutting interest rates this year was the productivity gains that we were seeing on the back of AI would deliver. And at the moment, because of this huge amount of investment and spending and the AI build out, it's actually putting upward pressure on prices.
Yeah.
So
it's as that translates into the real world and supply and demand.
Yeah, exactly. And last week, we had PCE inflation, which is a measure that the Fed pays very close attention to.
Okay.
It rose to 3.8%, which is the highest since March 2023.
Okay. So
I think the fact that this AI heavy investment, the rising energy demand, supply shortages, AI is putting upward pressure on prices. And that is forcing the Fed to recalibrate their assessment for interest rates, the trajectory of interest rates. And that is an increasing risk that we are paying close attention to at the moment.
So just thinking about all that then in context of clients and their portfolios, what should investors be doing and thinking about?
Yeah, we're very positive for the outlook for equities. Yes, you have to pay. The markets are expensive and we're a little bit cautious there, but the fundamental picture is very strong from a corporate perspective. So while we're optimistic there, we are carefully looking at how the Fed is reacting to these inflation woes and the increasing risks around that. And obviously that can have a significant impact on the economy, so on the bond markets and on the equity markets as well. So that is a key risk for us at the moment, and something that I think we're at a potential turning point of. But other than that, we're pretty positive.
Okay. So I think, as ever, we normally say stay balanced, don't stay ever concentrated in one part of the market, and stay awake.
I think that's true.
Yeah,
I think the things are expensive but good.
Yeah.
And there is a risk of inflation picking up again here.
Well, thank you. It's probably time for me to sum up what is in my Canaccord takeaway coffee cup today. So the rally isn't being driven by hype, or not only hype, but mainly by earnings. It's broadening out, especially to those sectors that are supporting the AI build-out, as you called it. So the physical build-out behind AI, data centres, etc., as well as into mid and small cap stocks. So that's another positive.
Absolutely.
But the same forces that are powering the markets may also be keeping inflation and therefore interest rates higher for longer, which might have an impact.
The US economy is running hot.
Yeah,
Let's put it
running
like that.
hot. I think Richard Champion said that to me last week as well.
Did he?
He did, yeah. And at that time, the weather was hot. That's all for this week. Thank you very much for listening to the Canaccord Coffee Break podcast. If you've enjoyed it, please don't forget to hit follow on your preferred podcast channel of choice, and you will never miss an episode, Tom. And as always, we'd love to hear your thoughts. Ask us anything you want. Drop us an email, coffeebreak@canaccord.com. Thank you.
Thank you very much.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.